Here's a trading tip, a secret. Big charts mean big money. Small charts mean small money. And the reason we focus on big charts like our weekly vertical crossovers for the incredible movement of tens of dollars, hundreds of dollars, depending on how long the move is and how big the chart is, or thousands of dollars, or tens of thousands of dollars. Again, depending on how many shares you buy in your virtual trading account. The reason we follow these big charts is unlike the ability of the market makers to twist around things and the control they have, the quant trading, the dark pools and all that. It is harder on a big ETF like the S&P 500 is depicted by SPY, which tracks 500 big companies, or the Qs, which is the NASDAQ 100, which tracks the big tech stocks, or things like 20-year bonds. That's what we see tracked on TLT, and gold, which tracks the price of gold at a tenth of its spot value. The reason we follow the ETFs we follow is because they are much less likely, I would say, to be manipulated. Now, can the whole market be manipulated? Of course, but it is much, much harder to do than single stocks or, in particular, short trades throughout any given day. That is the reason that we focus on big charts, mean big money. That is why we focus so hard on these weekly vertical crossovers. And look, a monkey can see this. You can see over and over again how accurate going back a year, 2 years, 3 years. I mean, you can start looking and you can find a few times where the moves did not work. But overall, most all the time, they do. That's why we focus on the weekly vertical crossovers and the big money that moves with it. That's why we want you to practice that. Okay, enough said there. That is worth its weight in gold, my friends. Remember that. Big charts, big money, big secret. Don't forget it. Now, let's talk about what's going on the weekly chart on the S&P 500, where we always start. What do we see going on? We see a sideways slide underway. Yes, the S&P was up today, 0.38%. Our Heiken Ashi candlesticks means average pace in Japanese. You spell that Heiken-ASHI, Heiken Ashi. And you can find our training at YouTube, at our website. It's one of the most popular in the world when it comes to Heiken Ashi candlesticks, and it shows you the average pace, which is a sideways slide. Now, the price percent oscillator is moving up at this time on the weekly chart. Derivative oscillator really hit a high, which is the high in the market so far, back or recently, back on the 1st of March, the week ending then, and has really been tapering off since then, sliding sideways. Price movement is below our weekly trend line. We have it's almost a doji, which means lots of indecision. Tending down is what we're seeing so far. We have our 2-day chart, and this is a little quirky here. It's still actually negative. Derivative oscillator's negative. We have and remember, the prior 2-day candle ended Friday, so Monday and Tuesday is represented by the green spinning top we have, which is indecision tending up. Now, again, still in a confirmed down move, hasn't really come off that lamination at this time. So waiting to see how the S&P 500 sorts out. We need to have it moving up on the 2-day because the weekly is currently moving up. And as we focus in on the 4-hour, what do we see there? Well, it crossed over going up in the morning and then basically about hitting where it was in the afternoon again. Like we said, 0.38%. Not comfortable in something that weak jumping in with the 2-day as flat as it is. But you know what? We don't have to take questionable moves. That's a beautiful thing about us. First rule in trading, in investing, don't lose money. Second rule, make money. So when it comes to the iffiness that we see of the S&P 500 right now, keep your powder dry. Don't do a practice trade. Remember, not a stock calling service. We're an education firm. Want you to train with us. We're not paid to, nor are we giving market advice. We go to the Qs. The NASDAQ 100 up 0.55%. This was the chart I told you to be on the lookout for. Prior week ended with a red open box spinning top. Now again, not a strong red down candle like we saw the last one back on the week ending the 28th of December, and then the Qs turned around, started moving up since then. But we saw some real questioning of the Qs over the last week, the NASDAQ 100, where it was going to go. Well, this week, so far, we have a green open box candle, still have a wick on the bottom, which again, doesn't make it as strong as the prior weeks that we had, the 8 weeks or so of strong up movement. Derivative oscillators peaked out in the week ending the 1st of March and is continuing to lose energy. But that price percent oscillator, which had been going flat, is now moving up again more. Price is still below that weekly trend line. And we see that price is also still below the 2-day trend line. Now, as we pay attention just on the weekly chart, we can see that that 2-day is still in a confirmed up move, unlike the S&P 500. We go to the 2-day, this latest 2-day candle bouncing off the red signal line, had a pretty, strong down 2-day candle ending Friday the 8th. That represented Thursday and Friday, pushing through the weekly trend line. Thought maybe the market could be rolling over. Didn't have any confirmation on that because the weekly's still in a confirmed up move and the 2-day still is also. So what do we see going on with this latest 2-day candle? Still has a wick on the bottom. So it doesn't mean that it's a super strong up candle, but again, does have a long wick on the top. Price movement is pushed above the weekly on the 2-day, which is good. Derivative oscillator still losing lots of momentum, and it has since it peaked out all the way back on the 18th of January. So we continue to watch. Again, paying attention, wondering how long is this move going to go. We told you to be on the lookout, though, in the morning for a potential jumping in point with a 4-hour crossover. We had one in the morning, so we had a jumping in point in the afternoon. Hope you guys practiced a trade on that, pulled the trigger unless you found something you didn't feel comfortable with and didn't do so. You could have felt some discomfort because price really didn't push above the 2-day trend. You don't ever have to trade. You can talk yourself out of any trade you don't feel comfortable with and wait for an absolute perfect time. Typically, that is when we have a weekly vertical crossover, because as you guys can look back on our charts and see, they typically portend strong long moves over weeks. And again, shorter moves when you get further and further in, because when did the last weekly vertical crossover occur? All the way back on Friday the 25th of January. And of course, we can look on that 4-hour chart and see the pullbacks throughout the course of that. And of course, it is getting a little long in the tooth. And again, as we look at where support levels are and all, just about where we are now. That's where we've seen in the past where things topped out. We'll just see. There's another level around 178, something like that. Another potential support level around 187. That's topping out on the very top of the market. So again, we'll continue to watch and see what we see. Hopefully, some of you pulled the trigger on that practice trade. I want you to pay close attention. Now that you've jumped in, what do you do to see what's really going on and help you follow the trade at this point? Well, you drop back now from that small chart to the 2-day and the weekly, and you keep up with what's going on those. Does the price movement stay above the weekly trend line? Does it try to get up and ride the 2-day trend line where it had been before? So let's watch that as things go along. If the trade doesn't make it and just dies on the vine, you don't have to hesitate to pull the trigger to get out of it. Getting in and getting out, the nice thing about the Qs and the S&P 500, very, very liquid, SPY and QQQ. You can get in and get out. And again, if you're buying large chunks of the ETF, as opposed to options, you can find yourself being in an extremely liquid position where you can pull out if things start to crumble on you. And you can be concerned because of how far away we are from that weekly vertical crossover. And when you look at the weekly chart, you can see, again, the derivative oscillator is weakening. We had a week of pullback where things were digested, but as long as you keep seeing the up candle move up and things strengthening, then you can continue to feel confident that things will continue to move ahead. But again, don't hesitate to cut your losses if things start to evaporate on you. But look again at those bigger candles, the 2-day and the weekly, once you pull that trigger to get into the trade. Okay, leaving stocks, going to bonds, up 0.70%. What do we see going on the weekly with bonds? Well, still in a confirmed up move on the weekly, and so far this week is one of the biggest weeks we've seen in a while. Green up candle forming. Again, we're not calling the candle yet. Why? Because a weekly candle takes 5 days to form. Only getting into it right now, 2 days, just to sort of see how things are going to wrap up. We see that the derivative oscillator is still negative. Price percent oscillator is trending up. Now, we have the weekly in a confirmed up move, but what about that 2-day chart? Well, we go to the 2-day and we can see that it's still in a confirmed down move, but the price percent oscillator is moving up, derivative oscillators losing downward momentum. If indeed that 2-day chart crosses over sometime this week or next week, and the weekly is still in a confirmed up move, might give us an opportunity later to jump into a move. We don't have a move right now, but we see a nice 2 up candles that have formed. We go to the 4-hour chart. What do we see? Up movement in the morning, much stronger up movement in the afternoon, pushing right up to that weekly trend line. So we'll continue to watch and see what we see and how TLT sorts itself out. That is 20-year Treasury bonds. Lastly, we go to gold. Gold up 0.61% for the day. We keep wondering if gold's going to cross over going down. It has gotten close, but has not happened. Derivative oscillators flipped over negative, but that all-important main indicator we use, the price percent oscillator, great training on that at the website. You want to truly understand the magic of the price percent oscillator. Very, very similar, but it's a percentage oscillator to the MACD, the moving average convergence divergence indicator. We love it so much better because it's a percentage indicator, not a dollar indicator, so it allows you to compare sectors with certain stocks in that sector, overall market with stocks or sectors. So again, it's very helpful in that way. So we look at what's going on that weekly chart. Hasn't crossed over going down, still in a confirmed up move, although we had 2 weeks of down movement, particularly that past week, solid down. We go from the weekly to the 2-day, and of course you can see that again we've got a green open box spinning top. Means indecision tending up, derivative oscillator still gaining downward momentum, price percent oscillator still heading down. It's got a long way to go before that 2-day crosses over in the up direction. So we'll wait and see if gold sorts itself out by that weekly crossing over going down. Don't know which is going to prevail, but whichever one does, we will then pay attention when both the 2-day and the weekly are in the same direction, because you got to have that interim or the intermediate 2-day and the longer term weekly in the same direction before you have a trend that's verified, okay? So we see that the 4-hour chart is moving up. We can see the derivative oscillator gaining upward momentum, price percent oscillator heading up. We've talked about sort of that floor around the 121.30 something mark there. We had it pop up off that floor on Friday and then sort of slide down on Monday and then pop up again on Tuesday. But what's interesting is not going above that 122.80 mark or so. We'll see if that up move continues or if things rotate over and test that bottom again. So we'll just wait and see what there is to see. That's where we are, folks, as we end the day on Tuesday and go into Wednesday the 13th of March. We so appreciate you being with us. You have questions, problems, concerns, you can feel free to write us, cw@chartingwealth.com. If you're a new student, a couple of things you need to do. First, go to the website, chartingwealth.com, sign up for our daily review. It also includes our once-a-week weekly review and forecast. Subscribe. You will get for free, of course, the things I just talked about. Plus, in the show notes, you will find links to our daily market worksheets, weekly market worksheets, how you can get what you're seeing, the layout that we use, you can actually get that from freestockcharts.com. We'll send you our layout, and you can upload freestockcharts.com. If you really love it, you can get the paid version. We give you a discount of $25 if you sign up for TC2000. And, of course, the link to purchase our book, Charting Your Way to Wealth. We're in our 8th printing. Just sent out a number of orders today, and we give you for free those PDFs for your daily, weekly, and trade worksheets. Want you to use those. And then go to the website, scout around, and once a day, I would urge you, sit down with pen and paper, listen to the trainings that we have. Just go through them. You can go through them randomly, but go through and spend a little bit of time, one at a time, maybe once a day, and go through all those trainings. They will be very, very helpful for answering the initial questions you have. I cannot answer a plethora of questions from everybody every day. That's the reason we recorded all of these great trainings for you, and the reason I wrote the book. And be happy to send you a copy of the book. Follow the link in the show notes, and you can order a book. We'll get them right out to you. And again, we appreciate you being with us. We care about your success, and it takes 10 minutes a day with us to get you on that path to training, to expertise when it comes to being a charting master. Because when you master this, you've got your own printing press. You've got your own printing press if you look at these charts and realize you can read them. We want you to practice, practice, practice until you get perfect. And then and only then can you consider making up your own mind to do with your own money what you've learned to do. God bless, my friends. All the best from the whole team here at Charting Wealth World headquarters.